You've been told for years that the dollar is unshakable, that gold is a relic, and that global finance moves on debt and digital payments. But look at what's actually happening right now. Gold is being pulled out of Western exchanges at a pace we haven't seen in decades. And the world's largest economic blocs are quietly building a parallel monetary highway backed by metal rather than promises. This isn't a conspiracy or a theory. It's a measurable shift in trade flows, settlement systems, and physical bullion movement. And if you're still relying on the old narrative, you're already behind. When 100% of gold futures stand for delivery in the first 3 days of a contract, something fundamental has broken. Historically, even 1% delivery was considered meaningful. Now, we have over $7 billion worth of metal leaving COMEX in a blink, and more than $100 billion has been absorbed since last November. That kind of flow doesn't happen because of retail investors or hedge funds. It happens because institutions are repositioning ahead of a larger shift. Hey everyone, this is Gold Rush Reporter, where we cut through noise and look at what the gold and silver markets are actually doing, not what people wish they were doing. And here's a simple question you should sit with while we dig in. If the mainstream narrative were correct, why would so much physical metal quietly disappear from Western vaults? What triggered this whole discussion wasn't a press release or a central bank meeting. It was the market itself. Delivery demand exploded, contracts stopped rolling, and the metal started moving out of the ecosystem. Analysts who normally ignore physical flows suddenly perked up because the numbers broke historical precedent. Meanwhile, BRICS nations have been strengthening trade circuits, connecting vaults across Asia and the Middle East, and rolling out settlement systems that operate without SWIFT and settle in gold balances. China's bridge network now links economies representing roughly 38% of global GDP, and those countries are trading in a system where the metal is the anchor instead of the dollar. At the same time, insiders in the US are reshoring physical gold, while policymakers hint at a return to gold-backed structures. The pieces aren't random. They fit together like elements of a transition that most people haven't noticed yet because it doesn't announce itself with headlines. Instead, it shows up in contract delivery ratios, trade realignment, vault construction, and payment rails quietly going live. And here's the part you're not prepared for. The shift isn't gradual anymore. The indicators that used to move slowly have accelerated, and the next stage hinges on a policy decision that could redefine the entire monetary framework. Let's cut through the noise and look at what is actually driving the gold market right now. The core issue isn't sentiment or narratives, it's physical flow. When you see an entire contract month stand for delivery, that tells you the market is no longer functioning the way it used to. Futures are meant to be traded, not settled with metal. But when participants demand the physical bars instead of rolling contracts forward, it means they distrust the paper promises. This isn't a panic, it's a structural shift in preference. And preference only changes when supply becomes tight or when counterparties appear unreliable. Gold supply in the West has been draining because the allocation is moving toward jurisdictions where ownership and access are more secure. When institutions fear that metal held in London or New York might be frozen or restricted, they diversify into vaults they control. This is why we see multi-jurisdictional storage networks emerging across Asia, the Middle East, and Russia. These vaults aren't symbolic. They solve a real problem, the same problem Venezuela faced when it tried to repatriate its gold and was denied. Countries don't build these systems because they enjoy bureaucracy. They build them because they want collateral they can actually take possession of. At the same time, mining supply isn't keeping up with demand. Ore grades are declining globally. New mines take years to approve, and capital expenditure has been weak because the industry has been conditioned to operate lean. You can't suddenly ramp up production when the physical ask is coming from sovereign buyers or state-linked entities. Firms can't print metal the way central banks print money. That creates a bottleneck that shows up first in exchanges, then in industrial channels, and finally in price discovery. Investor behavior mirrors this tension. Retail buyers move in and out based on headlines, but institutions act on risk assessment. The flows we're observing, hundreds of billions entering physical markets, aren't speculative. They're defensive. When central banks accumulate metal quietly, it signals concerns about the reliability of the existing settlement framework. And when trade routes begin to reorient around systems that settle in gold or gold-linked balances, the pressure on Western exchanges becomes obvious. COMEX stress is a symptom, not a cause. People misinterpret it as a crisis or manipulation, but the reality is simpler. The exchange relies on a fractional system where most contracts are never meant to be delivered. When a large portion of participants suddenly demand delivery, the structure reveals its weakness. That doesn't mean the exchange collapses. It means the metal leaves, and the remaining paper claims become less attractive. Geopolitically, the pressure is coming from countries that no longer trust Western financial infrastructure and are building alternatives. China's bridge network, multi-country vaulting, and BRICS-linked settlement systems aren't experiments. They're functional systems already handling trade. The fact that these networks settle in seconds and avoid SWIFT isn't a gimmick. It removes dependency on a system controlled by rivals. When trade settles outside of the dollar, the incentive to hold dollar-denominated assets weakens. Monetary policy adds another layer. Tightening liquidity pushes investors toward hard assets, and when the cost of capital rises, paper assets that rely on cheap leverage look fragile. Gold thrives when confidence in debt wanes, especially when debt levels are unsustainable. The interesting part is that physical metal accumulation continues even when prices stagnate, because buyers care about access, not short-term gains. The biggest illusion many people hold is that gold moves only because investors feel fearful. That's backwards. Fear follows supply strain, not the other way around. When metal actually leaves the system, sentiment adjusts afterward. Here's the uncomfortable truth. The physical market is tightening faster than the financial market admits, and the alternatives being built outside the dollar system are no longer theoretical. They're operational. And once those systems reach scale, the pressure on Western settlement rails won't be a slow drift. It will accelerate. And that acceleration is the part most analysts underestimate. Let's connect the dots between the structural shifts we discussed and what it means for gold and silver prices. First, the mechanics. When physical metal leaves exchanges like COMEX or LBMA, it reduces available supply for new buyers. Paper contracts can be created endlessly, but physical metal can't. That creates an asymmetry. Supply tightens, while demand remains steady or even grows. The market reacts predictably. Prices stay suppressed for a while, creating an illusion of stability until the scarcity becomes impossible to ignore. Then, very suddenly, the system reprices. Investor psychology plays a big role here. Most retail investors think gold is just a hedge against inflation or a safe bet. That's naive. Professionals see risk differently. They look at delivery risk, geopolitical exposure, counterparty reliability, and access to physical metal. When institutions start taking metal off exchanges, they're signaling a lack of trust in the system itself, not just a belief that prices will rise. And once retail catches on, fear accelerates the price move. This is why spikes are often sharp, not gradual. Here's where flawed narratives cloud judgment. People assume rising gold prices are driven purely by monetary policy or headline fear. Wrong. The biggest price driver right now is structural scarcity and settlement alternatives. The BRICS rails, cross-border payment networks, and multi-jurisdictional vaults are siphoning metal out of the Western system. Until this is priced in, the market underestimates how tight supply really is. Short-term effects are already visible. Elevated premiums on physical delivery, tight spreads in bullion, and unusual volume patterns on futures. COMEX contracts standing for delivery aren't anomalies. They're a warning sign. Long-term effects are far bigger. If global trade continues to settle outside the dollar, and gold-backed or partially gold-backed currencies gain adoption, the demand for physical gold will rise structurally, not just speculatively. Silver follows a similar logic, but with even higher stakes. Industrial demand makes it sensitive to macro shocks and mining constraints. Unlike gold, you can't hoard silver in enormous quantities without affecting supply chains. When global players start stockpiling, prices don't just rise, volatility spikes. Analysts who ignore industrial dynamics while focusing only on monetary factors are missing half the story. Let's be clear about hype versus reality. Narratives about gold going to $10,000 overnight are fantasy. What is real is slow, relentless accumulation of metal, coupled with systemic shifts in settlement and payment infrastructure. That creates the conditions for sudden repricing when stress crosses a tipping point, not fantasy-driven spikes, but structurally justified moves. And here's the tension point almost nobody is talking about. The global shift in payment systems and vault networks is quietly creating a bifurcated market. One side is paper-dominated, the old Western system. The other is physical, gold-backed, networked across emerging economies. When the two sides collide, when the old system struggles to supply metal and the new system demands it, that is when the market will face a shock that textbooks don't prepare you for. Let's stop pretending the market moves in clean cycles. The gold and silver setups right now are fragile because they sit on top of two opposing forces, tightening physical supply and financial systems still pretending everything is normal. That mismatch is where risk accumulates. When you have a market with limited physical inventory, rising strategic demand, and a paper structure built on leverage, you don't get smooth transitions. You get discontinuities. The next catalysts aren't mystical events, they're mechanical. One catalyst is continued delivery demand on futures exchanges. If the proportion of contracts standing for delivery remains elevated, it forces the exchange to either source metal or compress liquidity. Neither outcome is comfortable. Another catalyst is central bank accumulation. When sovereign buyers step in, they don't care about price. They care about access. That pressure is slow but relentless, and it compounds every month. Silver carries an extra layer of risk because its supply chain is industrial and constrained. Mining output has been stagnant, and a significant portion of silver supply comes as a byproduct of other metals. That means even if silver demand rises, production cannot respond unless copper, zinc, or lead demand also rises. This creates a structural bottleneck that analysts love to ignore because it doesn't fit a tidy narrative. Liquidity is the real fault line. Gold and silver prices behave normally when liquidity is abundant. When liquidity tightens, from central bank policy, credit contraction, or forced deleveraging, the weakest parts of the system crack first. Paper markets depend on confidence and credit lines. Physical markets depend on actual metal. When liquidity waves roll off, the paper side loses elasticity while the physical side becomes the anchor. That shift doesn't produce gentle moves, it produces repricing events. Recession signals heighten this dynamic. In downturns, investors dump risk assets and rotate into safe assets. But these safe assets only absorb flows smoothly when supply is available. If physical supply is constrained, the safe asset no longer functions smoothly. It gaps. That's not a prediction. It's a structural consequence. Let me be blunt. Anyone expecting a clean, predictable climb in gold or silver is deluding themselves. Markets with these characteristics zigzag and shock because the underlying structure is under stress, and stress accumulates quietly until something forces a release, a liquidity event, a geopolitical shock, a policy surprise, or even a technical failure in settlement rails. What is unlikely? A stable, low volatility environment while physical flows stay elevated. That setup contradicts the mechanics of supply and demand. What is dangerous? A scenario where physical demand accelerates while the paper market cannot deliver, because that exposes the leverage embedded in the system. What is realistic? Directional tightening. Not explosive moves, not fantasies, but a slow compression where premiums rise, spreads narrow, and the gap between paper and physical widens. Once that gap reaches a threshold, the market corrects abruptly. Analysts who only look at charts miss this because charts lag structure. Gold will respond first because it is the anchor asset. Silver will follow, but with more volatility because it sits between industrial and monetary demand. Silver's sensitivity means it will overshoot in both directions, which is why it looks unstable, even when the underlying drivers are consistent. Here's the part most people avoid acknowledging. The system is fragile not because of conspiracy or hype, but because it relies on confidence in paper claims while the real asset is migrating elsewhere. That's a structural weakness, not a narrative. Tie everything together. Deliver the final insight, the one message you want the viewer to walk away with. Make it sharp, logical, and impactful. Summarize the true meaning of everything discussed without repeating all details. Show the deeper opportunity or risk ahead. End with a strong outro for Gold Rush Reporter. Confident, simple, and aligned with your analyst persona. No begging, no hype. Just a clean close.